Thanks so much for tuning into Talking Point. I'm your host, Neeraj Shah, on the first day of the new Samvat. Absolutely delighted to welcome in Ajay Srivastava on the show to talk about his thoughts of how he sees markets and risk assets in general. And Ajay, if firstly, Sal Mubarak to you and the
Oh,
team and your family.
it's wonderful. Thank you. Same to everybody listening out there. I think we had a good year, and let's hope we have a better year next year ahead.
Yeah. Well, if risk assets needed a reason, the US inflation numbers, India inflation numbers, and the fact that the earnings season largely has not put one foot wrong, if you will, is that a perfect concoction for a further extension to this up move that we're seeing from the 19,000 levels, Ajay?
Well, I think two things, Neeraj. One, of course, is that the earnings season has given us a lot of things to ponder over because a whole amount of companies now are under, in terms of being very mediocre performance with respect to the PAT numbers. The growth in sales is very, very mediocre. So it's not been a healthy sign actually for the markets. Markets can do what they need to do. And today's mood is such that the US market went up for the last 2 days and the interest rates are controlled and then inflation is down. So all good pointers. But also what it tells us is that this is hardly the time when you go buy in the market. And the reason I say as follows, that no matter what happens, now you're buying, really speaking, PE expansions at this point of time. US PEs were far less and lower compared to Indian counterparts. So we should not compare and say US market went up, India should go up. India sits on a large base of valuation metrics, which has huge PEs for every stock. So to that extent, we are far more, I think, in a riskier asset at this point of time compared to the US companies were maybe a week from now. So I would be really say, temper down the expectation and the buying pressure, because if you buy at these kind of prices, how do you make a return out of that? If you took a 14, 15, 20% return on equities, given the debt is giving you 9 to 12%, therefore 18 to 20% returns are not easy. And you saw even last summer, the index did not give a return of more than 7%, lower than even the debt rate. So yes, it's a great day. It's a good opening to the market. Love this New Year opening with a bang. We all love New Year's with a bang. But at this point of time, hold your celebrations, keep your portfolio tight, and watch for companies where you want to sell. This is a season to look for what you want to sell, not what you want to buy.
I wonder why you say that, Ajay. I'm just asking you. I heard your comment on earnings, right? The expectations, and I have those numbers noted down. The expectations for Nifty sales, EBITDA, PAT at general consensus Bloomberg estimates were about 6%, 18%, and 21%. As versus that, the reportage has been 5%, 21% on EBITDA versus an 18% expectation, 28% on PAT versus a 21% expectation. Q2 has actually been pretty strong for Nifty as well as the broader end of the spectrum.
See, if you take out the banks out of the metrics of your calculations, then you see the real scenario emerging, that what is the real scenario. Banks had a really phenomenal growth in the last 2 quarters, and therefore that kind of takes away the average quite substantially. But if you look at the rest of the group of the companies, take us out this and OMCs, I don't even count as companies because they're government department at the end of the day. It's been pretty mediocre to say the least in terms of the growth of profits by and large everywhere, including growth of sales. Uh, Exemplary has been pharma, but all other sectors have kind of trudged along or managed to retain. If you look at the largest sector, cement, largest sector, steel, commodities, of course, have gone down at this point of time. So, the as they always say, statistics can be turned around to mean anything to everybody, right? You can please everybody with those statistics. But the real statistics is there are a large block of companies in India today are not reporting the growth in profits that is factored into their P's. P's are in 40s and 50s, and growth is at best marginal into even single teens, at the teen at best or single digits. Now, single digit and teens versus a 40, 50 P's is a dichotomy in itself. It can go on for long periods. I am not saying that, but that's not the way one makes a return out of the market. And we have seen historically when you buy at a high, and you saw what happened just a couple of months back when market was at a historic high, you paid a heavy price for holding those shares. So I would say caution, find sellers, create cash to buy is the mantra that we have been gone with, and narrow down your portfolio. Lots of sectors are not going to perform for a while.
Okay, so let's start with that. Where is it that you believe that the probability of underperformance due to earnings, due to valuations, due to combination of both is higher?
I think three sectors that we have identified. One is the cement sector, definitely, that's going to be a big one. Second is the chemical sector, which will underperform quite substantially in our view and continues to underperform. And I'm always talking, Neeraj, in retrospect, in comparison with the valuation. On a whole, everything can look good or bad, but compared to the valuation, I would say cement and I would say the chemical sectors. Both sectors are slated to underperform. FMCG will drag. Okay, that is a definite big drag on the system. Is going to be companies are decent, the liquidity is decent in those companies. People want to keep those shares. Leave that aside. But these three sectors are in for a drag in terms of performance by a large measure. And last point is NBFCs. I think NBFCs, we have been saying for the last 3 months, and they're not performing. They will not perform because competitive intensity is so high and the consumer spending is low that NBFCs have now gained what they had to gain. Now the customer segment left to lend to is the lowest, highest risk segment. And I think now we are at that levels in NBFCs. So last is NBFCs. These four sectors definitely are no go for us.
Okay. Well, the rate cut argument, if that comes about by virtue of what's happened to CPI, both US and India, might also play that hand, right? That banks might actually do better than the NBFCs going ahead. Just wondering, Ajay, the other aspect or the other way around. Ajay, just the other aspect, banks. You mentioned that if we strip off banks, then the numbers would have looked okay. But what about banks? The stocks haven't quite meaningfully rallied. And if you bake in an assumption that at some point of time the capex cycle does come about, maybe post elections, if you will, since the markets discount all of that 6 months in advance, and since the earnings are looking okay, and since the valuations are not looking obnoxious, are banks a good place to be in?
See, banking, okay, since we are much older people, we have been used to banking sector giving nominal returns because RBI kept it a closed circuit of 5 banks running this country. Look at the competitive intensity of this industry today. Enormous. Look at the 40 banks today competing for the same share of the business, same share of the pie. So therefore, how we used to evaluate banking sector 3 years, 5 years back compared to today is very, very different today. Okay. There's a cutthroat business out there. Number two, the biggest misnomer in the market, in our view, when we talk to corporates, we meet a lot of them, is that, somehow capex is linked to elections. Let me tell you, answer is no. Capex is linked to their demand scenario. When they see demand, they will invest. Elections, no election, doesn't matter. Any capex in any industry takes a year and a half or minimum 2 years to come together. So, you don't start a capex cycle based upon elections or don't start. You start it when you feel that there is an urge to expand, there is a need for the market demand. And that is where the problem is coming, that there is no demand expansion, which is why I'm saying our P's of companies belie the underlying demand of the economy. Leave aside the government spending sectors like railways, etc. All other sectors, are they experiencing such a demand growth that companies want to invest? The answer is no. They're able to tweak it around, they're doing many things to it. But really speaking, private sector investment is lagging, not because of elections, not because of interest rate, but purely because there is no demand to allow for this capacity expansion. There's enough capacity in the country at this point of time to cater to most segments. And you've seen where capacity is being created, cement, what's happened to the share performance of those industries where you see huge capacities coming up.
Okay. In which case, I presume that even on the capex related theme, you might not be as constructive.
No, capex, we are very constructive. To be honest, quite a bit of our investment is in capex teams and large MNCs in the capex team, and they're doing well because they straddle industries, they straddle petroleum companies, they straddle Middle East. At the end of the day, why do we look at India? We need to look at Middle East as well, where petrodollars are fueling a kind of boom if you travel around and see the expansion. So no, capex remains our number one theme, of course, in this industry, in the Indian context, Indian market. We are heavily invested in companies delivering capex, and more so, companies delivering capex to railway sector. I think that's been our biggest portfolio choice, which has done well. So both defense and this, I think, are doing astoundingly well and will do well because government needs to keep spending money. Election year, they don't hold back the money at the end of the day. So next 12 to 18 months, it's a good time for capex industries, no doubt in my mind. But this is a very niche industry, not more than 7-8 companies. And therefore, it's good in a way. You can build a portfolio, bad in a way that you don't have too many choices and the choices are expensive.
Okay. I'm trying to throw a few darts at you, Ajay, out of the blue. I don't know if you've looked at these sectors or no, but if you have, would love to have your thoughts. I was talking to a company Dynamatic Technologies, which did a tie-up with Airbus about a few days back, a contract with Airbus, $70 million odd. He was saying, the management was saying that it's not just Dynamatic, but a clutch of Indian aviation, global aviation related plays in India, which will do well because the global aviation market is looking at India for supplies, de-risking, what have you, and just the assurance of contracts. This morning, there's a company called PTC which has done some JV with a French aviation company as well. Have you had a chance to look at some of these niche suppliers which are signing up these contracts with global companies of the size of Airbus and Boeing and talking of multifold growth in the years to come? Have you had a chance to look at them?
Oh, yes, certainly. In fact, it's quite surprising that there are lots of unlisted companies as well in the space, and they'll be coming up for listing. We saw a company which is amazingly is the most complex turbine maker and blades maker in the world. It supplies to all the aviation engine makers the blades which go into the engine. So it's really speaking at the highest end of sophistication. And I'm talking of companies with an EBITDA margin of 60% plus.
Wow.
Engineering companies, EBITDA margin of 60% plus.
Unlisted.
In aerospace.
Unlisted.
Unlisted.
Okay.
Unlisted. It's a very large, nice company. It'll be coming up for listing very soon. So yes, there is a thing. Although having said that, I think, in all these companies, including the company you name, has had, unfortunately, flattered to deceive over a period of time.
Yeah.
So you got to pick and choose. The performance has been erratic. The company you name has been on the horizon for quite investors for maybe almost a decade now. It's not today. First they were in two-wheelers, then they went to autos, they were in autos, went to two-wheelers, or wherever they were. And they went all over the place. So,
yeah.
So for a shareholder, I think it's important to understand that you need to pick and choose. And if once the guy has gone off the rails, for whatever reason it is, you need to get out of it. So yes, aerospace is very good. A lot of companies coming up in this space. We will get a lot of IPO options in the next 12 months. And that's the beauty of this country. Why I say is good. Why talk about cement? Why talk about steel? There is so much new ideas coming to the capital market that you just don't need to just blank your mind out and say, some sectors I had invested once, I will not invest. This is what I've told my team. Do I want to hear cement? I don't want to hear steel. Tell me all the new companies that we are investing in, new model. You saw what happened to the airline lounge company. Fantastic performance. You see normal buns, Dr. Victor. Okay, we hold so for disclosure. Look at the performance. So, the beauty of today is I wish I was born 20 years later. The kind of stuff I'm seeing today, I really say,
Ajay, well, I just hope you live 20 years longer than what you envisage right now, because that will do up for all of this, and may it be healthy 20
Can
years.
I show you pollution? Can I show you pollution outside? It's reducing it every day.
I'm just saying, let's hope that things improve and we live longer despite the issues, not because of them. Okay, I have
but the beauty is, Neerav, what I'm telling the investors is, look at new ideas, get onto the new bandwagons. Don't worry about market saying expensive, less, not. These are just starting off. If you have a 5-10 year horizon, lots of these companies will give you lots of value. The old players, as always they say, the old stars fade away, the new things come. This is the age of new companies. Buy 60-70% of a portfolio should be companies which have come up in the last 10 years or 5 years. That's the way we move our portfolios now. We are very clear that 60-70% has to be in companies less than a decade old.
Wow, that's an interesting take too. The other aspect, Ajay, is some businesses which have shown very strong growth and the promise looks very strong for the years to come. So Ethos, for example, today is up about 10%. Luxury, premium end, K effect, all of that into place. Expensive stock, still up 10%. And we've seen that with a clutch of companies wherein the delivery is strong, then market is paying scant regard to expensive valuations. They're taking these stocks higher. The bids are higher. What about this premium consumption-led themes, be it cars, be it watches, be it vineyards, be it malls, what have you? What do you think of this?
See, premium is good. More expensive, better. Problem is we don't have enough stocks in this country. You spoke about a watch chain, it's expensive stock. And what do you do with it when you buy at this rate? Because at the end of the day, it's a trading company, by and large. So it has a moat, but how much is the moat? We need to see that, examine. But there is no doubt that the people who are rich in India are doing so much better. They are spending money. But we don't have enough opportunities to invest. At best, you can go to a hotel company, invest it, but hotels are long gestation kind of stuff. So, so the sheer dearth of stocks which cater to the high-end market in India. And unfortunately, For India, high-end means foreign brands. Okay, so they're going to splurge on LVMH. They're going to splurge on, whichever brand they want to choose. To you go buy Jimmy Choo's or Louis Vuitton or whatever it is, but you can't buy those stocks in India, and therefore, to an extent, you have to stay out and keep watching even the car companies. We don't have a luxury. We don't have a Ferrari, Lamborghini, and so on. But that's okay. That's not to worry about it. That's why I said that K has two connotations. K has the ultra rich driving around in the Lamborghinis, and K has also a scenario of new age products which are being consumed by the new age Z Zen, X Zen, whatever you want to call them, people. And I would look at K from that perspective. That to me, K is consumption themes which are driven towards newer sector of consumers, not the older. And I think that's where ethos also fits in. That's the way people are buying jewelry, people are going to buy watches, and so on and so forth. So I think it's a good theme. Now, expensive. The conundrum is, this is what there used to be old Indians saying, ki khao to pastao, nahi khaoge to bhi pastaoge. So you have to live both ways. So my maxim's always been to investors who ask me on the airports, and the thing is, was if you like a stock, it's expensive. Say you want to buy, put 20 lakh in a stock or 10 lakhs, put 2 lakh first. Don't worry. If it goes up, put one more lakh. If it goes down, don't stop, then add a lakh to that. Don't need to buy today morning when the market is in a high, 10% up. I don't need to go buy today. Have patience. Market corrects. All markets correct. And I think that's the bottom line. And in our office, for instance, the maxim is you need to buy only on the days we have a red tick in the market. Okay. We don't like green ticks at all for buying. Selling, we love the green ticks because we don't sell when there is a red tick. We sell with the green. You buy when there is a red tick. I think you follow that maxim, you will have a decent average to build into your portfolio. FOMO is a disaster for your portfolio. Patience is a virtue. Wait, all markets correct. All markets correct, and you will get a chance.
Okay. One final question, Ajay. You mentioned about how there are some very nice new age themes that have come out. And you are by and large cautious though on the markets. I would love to understand where is it that is your highest overweight position in your portfolio currently, which you believe ceteris paribus that might continue. Part one of that question is that, and part two is if it is from a new age theme, then great. If it is not, then also tell us where within the newly listed firms or the new age themes, the recent themes in the last 5 years, are you the most overweight on?
See, okay, I'll disclose it. There's nothing. Please don't take it as a recommendation. My highest exposures are the two of the largest exposures of our personal money. Personal money, I'm telling you about it, is Paytm and Zomato at this point of time. These are two of the largest in the new age companies. And the third, which is just below that, is DreamWorks, which we bought quite back. And in the old age companies, our largest investment at this point of time in BSC, as well as a company called HBL Power, which does the systems for railways. So I think so it's quite amazing that it's a one side is something like a stock exchange, which is the oldest thing in the world, all right, and the other side is a newer stage company where we think of payment systems. What they have done in this country is unparalleled, cannot be done again by anybody. The moat is huge, and I think it is an example to the world. When you travel around the world, you feel so proud that we have a payment ecosystem which is second to none in the world needed. And I think it's a great pride for us that we are an Indian company who did it for us. And so I think this is the holding that we hold today in terms of largest to smallest. Disclosed it. It's my personal holding, so that's what I can tell you.
Okay, no, so I just want to wrap this up, not with the names, Ajay, but with the thesis of why. So I heard you speak about Paytm. BSE is now known per se, I mean, a moat out there, two exchanges, fine. Why a food delivery company? Is it the Zomato promise? Is it a Blinkit promise, which is not yet discovered? Or is it a combination of both over the years?
No, I think we have invested only on the theme that ultimately this will become an advertising company. It will make the kind of money Google makes on advertising. It will kind of money Apple makes on advertising. The rest will become peripheral over time in a couple of years' time.
Can you explain that, please?
Okay. See, when so many millions of people are logging onto your site at this point of time, that's the place where you can encash eyeballs, not only with your own self-delivery customers, but with anybody in the system who wants to access this customer base. Who is this customer base? Mobile, active, database who want to, right? So imagine the number of people logging on to a company called Z, all right? And therefore the eyeballs it captures every day. Now, when you turn that into an advertising engine, what does Google do? Convert your search into an advertising engine. this will produce more revenues from advertising in our view in 3 to 5 years than it does on any other stream of revenues in our view. And that will be phenomenal moat, because you can't take it away from somebody at the end of the day. And you can see in the monopoly Google has, or Apple has, on advertising, or Facebook, Instagram has at this point of time. So therefore, in our view, this particular company would become an advertising juggernaut over a period of time. Blinkit and delivery will all be there, but that's going to be outstripped by revenues coming from advertising. And that will be the humongous part. And you know for sure that all companies are putting more and more money in digital space than in the space. And the beauty, it's an Indian company. So even if regulations change in advertising and data integrity and data storage, there is no issues. It's a pure Indian company. You don't have a problem with Google, but you won't have a problem in Z, but you will have a problem with Google. So I think purely on that thesis, we've invested, and I think it's done well. And I think it should hopefully, God's grace.
Such a treat talking to you, Ajay. Thank you so much for taking the time out on the
Wonderful.
first day of the new Samvat and talking to us. Or rather, first day of the new Saal, if you will, post the Saal Mubarak. And see you soon.
Thank you. All the best, sir.
Thank you so much. And viewers, thanks for tuning in.